Hello traders, it's been a while. We've dropped a video again, so I decided to drop a video today, and I wanted to continue from where we stopped. So welcome to Babypips Forex education course. We have completed course 1, course 2, 3, 4, 5, 6, and 7. And so today I want us to begin with course 8, Undergraduate, Sophomore. And here are the course outline: the US dollar index, intermarket correlations, using equities to trade FX, country profiles. And so the very first one, the US dollar index, it has subtopics as usual. We have about how many of them? 6 or so. Yeah. So what is the US dollar index? How to read the US dollar index, how to use the USDX, okay, for forex trading, and trade weighted dollar index, Bloomberg dollar spot index, the dollar smart theory. So let's discuss the first one before we move on to the very second one. Okay, and now we're done with all the technical analysis. I mean, I think we should have a little bit of technical analysis to come or something like that. But so here they are primarily just history and theory, okay, and so I'll go really fast. Most of these things here, they are not really necessary, okay, so I'm really going to go so fast. So to begin, as usual, let's roll the intro and then we'll come back and discuss the US dollar index. So let's roll the intro, buddy. Welcome back, traders. And so here we are on the US dollar index. What is the US dollar index? USDX. Now let us just read to get a sense of it. Now if you've traded stocks, you're probably familiar with all the indices available, such as the Dow Jones Industrial Average, okay, Nasdaq Composite Index, Russell 2000, S&P 500, Wilshire 5000, and the Nimbus 2001. Okay, so there are a lot. Now so for currency traders, we have the US dollar index, okay, and to be technically correct, the ICE US dollar index. So what is the US dollar index? Okay, now it is very similar to how the stock indices work, in that it provides general indication of the value of a basket of securities. So what securities are we talking about? They are major world securities. So all these are the basket of securities that is weighted against the US dollar index. Okay, so in total there are 6 foreign currencies: Euro, JPY, GJ, okay, and the British pound, Canadian dollar, Swedish Krona, the Swiss franc. Now we just saw 6 here, but if we break down, Euro alone, there are many countries inside the Eurozone. Okay, so in Euro alone, there are 19 countries in the Eurozone, and so if you add 19 plus the 6, that will give you 24, right? I mean 19 plus 5, yeah, 24. So the 24 countries make up the Eurozone, okay, that are traded against the US dollar. So in a nutshell, to put it very simple, all these other currencies, right, they are traded against US dollar. Why? Because the US dollar is the, how do you call it, the official reserved currency of the whole world, right? In the whole of the world, US dollar is a reserved currency, foreign reserved currency. So what does that mean? If you are in Russia, for instance, you have a company and you want to buy something from what is it called? Maybe some products or whatever it is. Maybe you want to import computer games from Yokohama, or maybe you want to buy power bikes from Japan, okay, and the Japanese seller or dealer, whoever it is, a merchant, will request you to pay in the United States dollar. Okay, so you are from Russia, he is in Japan, and you are paying him in the United States dollar. Why? Because the United States dollar is a reserved currency of the world, okay, and so That is the reason why every other currencies that are weighted in this basket are traded against United States dollar, because it's the reserved currency. So what is the ICU? I mean ICE. Now the ICE, the designations US dollar index or dollar index and USDX are trademarks and service marks of ICE Futures US Incorporation. So the ICE is the US is the Intercontinental Exchange Group. Okay, so it is basically the body that incorporates US dollar index. Okay, I hope you get that. So this is like a big brother. Oh my goodness, it's like a big brother to the US dollar index. Okay, so now the ICE operates 13 regulated exchanges, including the ICE futures and over the counter exchanges in the US, Canada, Europe, and Singapore. It also is a parent company of well-known New York Stock Exchange. Okay, so today for the US dollar index, it is actually known officially as ICE US dollar index. Okay, that's the official name. Began in its operation in 1985, and it complies with and maintains, determines, and weights the components of the US dollar index. Okay, so it's the US dollar index can be traded as futures contracts for 21 hours a day on the ICE platform, and the US dollar index contracts derives its liquidity from the spot current market, estimated to have a turnover of over 2 trillion daily. Let's leave all that. So the USDX, all these are just acronyms. Okay, so what is USDX versus DX and versus DXY? Now they are names, they almost mean the same thing. So USDX is the umbrella term for the US dollar index. Okay, now DX, the ICE exchange symbol for the futures contract is DX, followed by the month and year and code. So if it is in the ICE, they want to refer to the US dollar index, they will just say DX. Okay, now what about DXY? Now DXY is a popular ticker or symbol used by Bloomberg terminal users, so that the index is referred to as the DXY. So when they are when spot traders want to refer to the US dollar index, they don't say DX, they just say DXY. So people who use DX, they are those who trade futures, okay, on the ICE. But spot, like forex spot market, okay, people who trade the US dollar index, they refer to it as the DXY. Okay, so understand that. Now the US dollar index components, what other components? They are all we have just said. Okay, all these countries here, the world, okay, under the euro, they all make up the US dollar components. Okay, so there are two ways the US dollar index can be traded. So the first one is trade weighted dollar index and the Bloomberg dollar spot index. Okay, now is the ICE US dollar index adjusted or rebalanced? Sometimes it is, sometimes it is not. Okay, but before so there are no regulated, there are no regular scheduled adjustments or rebalancing of the ICE US dollar index. Okay, so the ICE, specifically ICE futures, monitors the index methodology to ensure that it properly reflects the covered currencies and the FX market in general, and makes adjustments as and when necessary. So how is the US dollar index calculated? Should we really go in, but do we really care? Do we really care? Okay, but it's a total, they know how to do it. Okay, so where can I get real-time prices for the ICE US dollar index? You can get the real-time prices at Bloomberg, can get it at MarketWatch, CNBC, Wall Street Journal, and Yahoo Finance. Okay, and so here's an example of the US dollar index futures. Okay, so that is what the US dollar index is all about. So without further ado, let's move on to the next section, the next lesson that says how to read the US dollar index. So here we are on how to read the US dollar index, and now let's look at the chart. It is basically the same thing. If you can understand how technical analysis work, price is going up and down. It also shows the value of the US dollar index. Okay, if price is making higher highs, higher lows, the value of the USD index is going up. Okay, so the US dollar is stronger compared to the other currencies with which it is weighted against. Okay, so now if the dollar is going down, it means all those other currencies, they will be more valuable. The US dollar will be weak. Okay, so you know what to do. You short any pair with which it is traded against. You just short the pair, so that I'm not going to go into technicals, all these readings and all that. We don't need them. Actually, we don't need them. Okay, so once you look at the chart, US dollar index chart like this, and you can only get this on trading view. Okay, so when you look at your US dollar index chart, you know what it's doing. Okay, lower low, lower high, lower low, lower high. Okay, so okay, the US dollar index is weak. So that's basically what it is. So let's go to the next lesson that says how to use the USDX for forex trading. So here we are on how to use the USDX for trading forex. Okay, and this is not really difficult to understand. I think we said that earlier on. Now so let's look at the chart. This is here. It is this is the USDX daily chart. Okay, now if the US dollar index chart is trending up, okay, USD dollar chart is trending up like this trend you're seeing right now, all the base currency pairs of the US dollar will be trending up. However, if the USDX chart is going to the downside, all the base US dollar currencies will also be going to the downside. Okay, so let's look at a very clear example here. Here's the daily chart for USDX. Okay, we're going up and down, up and down. Now let's look at the charts. Now here the US dollar is the quote currency, not the base currency. Okay, now we'll see what is happening to the euro here. The euro is going down. Why? Because this guy here, the US dollar, is rising up. Where? Over here. Okay, so I don't know if you understand that. Over here the US dollar, okay, is rising. Over here Euro USD is falling, which means this guy here, the US dollar, is stronger than the euro, so the euro will fall. So over here it is going to be fall. If it were to rise here, it means we'll bring the US dollar to the side. Okay, but because this is Euro USD, the euro is the base currency, USD is a quote currency. I think you should understand it because we've done all this before now. So let's take another example. This is a very clear example. Now here we have the US dollar index. Okay, it's on a roller coaster going up. Okay, going up the top side. USDX daily chart. Now let's look at US dollar CHF. Okay, so because the US dollar CHF is the US dollar is a base currency, see what the price is doing. Price is also tanking to the top side. Exactly the same thing. Okay, so I hope you understand that. So that's how to use the US dollar. You can use the USDX as your traded indicator for the US dollar pairs. So here are two little tips you should always remember. If the USD is the base currency, like USD and whatever, then the USDX and the currency pair should move in the same direction. Now if the USD is the quote currency like GBP USD, then the USDX and the currency pair should move in the opposite direction. That's how you trade with the US dollar index. Now the next lesson to talk about is trade weighted dollar index. So here we are on trade weighted dollar index. Now it is created by the Federal Reserve and is now widely used by most people. It is called trade weighted US dollar index, and there's actually no particular website you can find it, but it is here. And BBPs didn't put the website name here, so but if you click on this link and you can see it below, fred.com stlouisfed.org. I'm looking at it at the left hand corner. Okay, so let me just open it in another page. So here it is, fred.stlouisfed.org. Okay, and then you can see the trade day weighted dollar index. So what actually is it? It is more comprehensive than the US dollar index in the sense that it adds more countries to it other than the normal 24. It added developing countries and other countries alike into it. So you have exhaustive list, like you have Russia here, you have Israel, you have Philippines, Colombia, and all that. So what do they really do? They compute or they put data of transactions on a yearly basis, and they just add it to it. The point is they are trying to get the actual rates or current currency figures of the US dollar index. So in my own opinion, I don't think this is really actually necessary, but if you want to use it, you can use it. So let's move on to the next lesson that says Bloomberg dollar spot index. So welcome, and here we are at Bloomberg dollar spot index. Now, so the Bloomberg dollar spot index tracks the performance of a basket of 10 global currencies against the US dollar. Now, its composition is updated annually and represents a diverse set of currencies that are important from a global trade and liquidity perspective. Okay, so now talking about this sentence alone, its composition is updated annually, that is to say every 12 months, and it represents a diverse set of currencies that are important from a global trade and liquidity perspective. So now, since this information is computed annually, do you really think you really need this Bloomberg dollar spot index? Okay, do you really think you need it compared to the DXI US dollar index as you have in TradingView? No. So let's just go through this quickly. Bloomberg, they boast that they have the current DXY index, and so every year is when they compute it. Okay, and here are the rankings of the current countries in which they have computed to make their own whatever it is they're making. Okay, to come up with their own figures. Okay, that is more accurate compared to that of the ICE. Now, so here they say the Bloomberg dollar spot index is more diversified. Okay, so this is Euro, JPY, and all that, and unlike that of the ICE and all that. So you really do not need all of all this. It's not necessary for me. I'm not sure we can actually use this for any trading decisions, but let's just know that Bloomberg has dollar spot index that they're using as well, and it's not cheap, it is expensive, so they also offer balancing and all that. So the index rebalances once a year to incorporate new data from the annual survey of major trading partners versus the US dollar as reported by the Federal Reserve, the triennial survey of most liquid currencies as reported by the Bank of International Settlements. Okay, so at each annual rebalance, the following steps are taken to select which currencies to include and their weight. So they identify the top 20 currencies in terms of trading activity versus the underlying currencies. So they identify also top 20 currencies from the China Central Bank survey of foreign exchange and derivatives market activity. And also they select the top 10 currencies of both lists, but exclude any paired currencies and all that. So all this they put it to play to come up with their figures. Okay, so how to view the Bloomberg dollar spot index? So for Bloomberg subscribers, you can run the Bloomberg dollar spot index on the Bloomberg terminal to view the Bloomberg dollar spot index. Okay, if you can't afford to pay 20,000 US dollar annual fee for a Bloomberg dollar terminal subscription, you can access the live Bloomberg DXY the extra quotes for free on Bloomberg's website. Okay, so let's just open this link and see what it comes up with. So here is the feed. Here is the Bloomberg dollar spot index figures, and yeah, you have the right to do more research about that. And so that brings us to the end of that lesson. So next lesson we're going to talk about the dollar smile theory. So here we are on the dollar smile theory. So what is it about, or what are we going to learn from the dollar smile theory? Now, currencies tend to fall when their country's domestic outlook worsens, but the US dollar index, US dollar unique global role makes it special. So when the US economy isn't doing great, the currency might still rise. How do we explain that? So let's divide the US dollar into two, okay? One for domestic and one for international trade. Okay, so domestic within the country, international outside the country. Now, so let's say the economy, okay, of the economy, US economy is not doing well, okay, and GDP is down and all that. What can happen is that, yeah, it can affect the dollar, okay? The economy can be weak, okay? The outlook can be weak. However, the dollar index might still rise. Why? Because of the international, consideration of it. People still use it as a reserve currency of the world. There's still transactions going on using that particular currency, US dollar. So that factor alone can strengthen the US dollar. Do you understand? So what does the US dollar, the dollar smile theory indicate? This theory was invented by Stephen Jen, a former economist at the International Monetary Fund and Morgan Stanley. He now runs his own hedge fund and advisory firm, Eurozone SLJ Capital in London. He came up with the theory and named it the dollar smile theory. So here the theory is, okay, and this is the illustration. The very first part of the theory says the USD strengthens due to risk aversion. USD weakens to new low due to weak economy. It strengthens due to economic growth. So scenario one, US dollar strengthens due to risk aversion. So let's say, for instance, because of the global pandemic that is going on right now, everybody is all economies are, trying to save, their portfolios. Okay, so where do you put all your money? Where do you save it? Which currency is best for you to save your money with? And now, because the US dollar is the reserve currency of the world, everybody can basically say, okay, well, let's use the US dollar because it's the reserve currency of the world. Anybody going to do international trade, whatever it is, they're still going to use the US dollar. So so to avert risk from their economy, okay, they might buy bonds in the US, or buy treasuries in the US, or buy more assets, in the US, just to make sure that capital they have, doesn't lose value in their own currency. Okay, so they invest the money in the country. So what happens when they invest the money in the country, in the US dollar? Okay, they are averting risk. Okay, so that can make the US dollar to be strong. Okay, so that's the first reason for, I want to say, the US dollar strengthens due to risk aversion. Other countries pumping their money into the United States economy. Now, scenario number two, US dollar weakens to new low due to weak economy. Okay, now, so the US dollar the economy is weak, and now the GDP the country is producing has dropped. Okay, people no longer have much confidence in the economy and in its GDP, and so even all over the world, people who ought to be using the US dollar for international transaction, what do they now do? Because the GDP of the country is low, and all that, nobody wants to trade or store their money with the current country by that time. And so what do? They just sell the economy. I mean, they sell their assets, whatever it is they have, and they sell and buy other currencies. Okay, so what you'll be hearing then is sell, sell, sell. Okay, so seeing here, so that's what happens. And so in this stage here, nothing is actually happening. The dollar is going down because the economy is down. Okay, and so also the GDP of the country is also down. Now, the third scenario of the SMART theory is that the US dollar strengthens due to economic growth. Okay, so now optimism begins to pick up and signs of economic recovery appear again, and the sentiment towards the dollar begins to pick up. So in other words, people now have confidence in the US economy and in its GDP, and expectations that interest rates is going to spike up. So in that case, people pump their money into the US to buy more assets, buy whatever it is they want to buy, however they want to invest the money and all that. And also what happens, the economy, the dollar rallies to the top side again and becomes strong. So that's basically the idea behind the US dollar, the SMART theory. Okay, so that's basically the idea. Without wasting time, let's move further to how gold affects AU and USD, how gold affects them. So with that, with this lesson, the dollar theories, so with this lesson, the dollar SMART theory, will come to the end of module 8.1, because it ends with the dollar SMART theory. So with that, we want to wrap this up, and then we're going to come back again to discuss lesson 2. Okay, so if you have enjoyed this section, please don't forget to share this video. Okay, smash the like button, subscribe if you haven't, and until next time, see you soon.